Brad Williams, Frugal Finance, understanding Treasury bills, what they are, and how to invest. A Treasury bill, also known as a T-bill, is a short-term debt security issued by the U.S. government through the Department of the Treasury. These instruments are typically sold with maturities ranging from a few weeks up to 1 year, with terms generally set at 4, 8, 13, 26, and 52 weeks. T-bills are issued at a discount to their face value, meaning investors purchase them for less than their nominal value, and the full face value is paid back when the bill matures. Key takeaways: Treasury bills are short-term government debt with maturities of less than 1 year. These bills are sold in denominations starting at $100 and can reach up to $5 million in certain cases. T-bill rates fluctuate based on expectations of future interest rates. Investors can purchase T-bills directly through Treasury Direct and official U.S. government platform. How Treasury bills work? The U.S. Treasury issues T-bills as a means to raise funds to cover government expenses. These securities are usually held until they mature, at which point investors repaid the full face value. T-bills are sold at a discount to the face value, which means that investors pay less upfront and earn interest as the bill matures. For example, if an investor buys a $1,000 T-bill for $950, they'll receive the full $1,000 upon maturity, earning $50 as interest. Importantly, T-bills do not make periodic interest payments. Unlike other bonds, instead, the interest is implicit in the difference between the purchase price and the redemption value. Investors can purchase T-bills either through a brokerage or directly via Treasury Direct. If buying directly from the Treasury, the process involves creating an account, selecting the desired security and maturity, and submitting payment details. T-bills and market factors. The yield or interest rate of Treasury bills depends on broader economic factors, including the U.S. Federal Reserve's monetary policy. When the Fed is engaged in expansionary policy, such as lowering interest rates, the demand for Treasury bills increases, which drives up their prices and reduces yields. Conversely, when rates are raised, T-bill yields tend to rise as well. T-bill rates also reflect investors' expectation about future interest rate trends. If the market anticipates a rise in rates, longer maturity bills will offer higher returns. Conversely, if rates are expected to fall, short-term bills may provide more attractive returns. Understanding the taxation of T-bills. Interest earned on T-bills is exempt from state and local income tax, but is subject to federal taxes. Since the interest is built into the purchase price, i.e. there are no coupon payments, investors should be aware of the tax implications when their bills mature. Advantages and disadvantages of T-bills. Pros: zero default risk. T-bills are backed by the full faith and credit of the U.S. government, making them one of the safest investments available. Low minimum investments. Investors can purchase T-bills for as little as $100. Exemption from state and local taxes. While subject to federal tax, the interest earned on T-bills is not taxed by state or local governments. Liquidity. T-bills can be easily bought and sold in the secondary market. Cons: low returns. Compared to other debt securities, T-bills generally offer lower returns, especially in environments with low interest rates. No ongoing interest payments. T-bills do not provide periodic interest payouts, which may not suit investors seeking regular income. Interest rate sensitivity. T-bills are sensitive to changes in interest rates, which can reduce their attractiveness in rising rate environments. The Federal Reserve's influence on T-bill prices. The Federal Reserve's monetary policy has a significant impact on T-bill prices. When the Fed raises or lowers its federal fund rate, it directly influences the demand for T-bills. A higher federal funds rate typically leads to lower pricing for existing T-bills, while a lower rate can make them more attractive and increase their prices. Example of investing in a T-bill: if you decide to buy a 1-year T-bill with a $1,000 face value and a 5% yield, you would pay approximately $950 for the bill. At the end of the year, the T-bill matures and you receive the full $1,000. Your $50 return represents a $5 yield on your initial $950 investment. How inflation affects T-bills. Inflation can erode the real value of returns from T-bills. If the inflation rate exceeds the yield on a T-bill, the purchasing power of the return decreases. For instance, if you invest in a T-bill with a 2% yield but inflation is 3%, you would experience a real loss in value even though your nominal return is positive. Should you invest in Treasury bills? T-bills are an excellent choice for conservative investors seeking a low-risk investment that preserves capital and offers liquidity. However, their relatively low returns may not be suitable for those seeking higher yields or those looking to outpace inflation. They can be a solid option for parking cash for short periods or maintaining a diversified portfolio of safe investments. Other U.S. Treasury Department instruments. Treasury bills are just one type of debt security issued by the U.S. Treasury. Other options include Treasury notes, medium-term securities with maturities ranging from 2 to 10 years, Treasury bonds, long-term debt with maturities of 20 to 30 years, Treasury inflation-protected securities tips, bonds designed to protect against inflation by adjusting the principal in line with the consumer price index. Conclusion, Treasury bills are a secure and straightforward way to invest in U.S. government debt. They offer a low-risk investment option with predictable returns, making them a popular choice for conservative investors. While they may not offer the higher returns of riskier investments, their safety, liquidity, and tax advantages make them a valuable component of many investment portfolios. If you have any questions about Treasury bills, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.